A lot of retirees are shocked to find out that up to 85% of their Social Security could be taxed, especially if they were told it would be tax-free. And what really matters isn't your age, it's a number that most people don't even know exists. In this video, we'll talk about whether or not you're going to pay taxes on that Social Security retirement income and how you can figure out how much tax you're probably going to pay. And we'll also get into some strategies that can help you manage those taxes. It all comes down to your income. Whether or not your Social Security benefit's going to be taxed depends on something called combined income. It's not your tax bracket, not your age, and not just the size of your Social Security payment. That combined income consists of half of your Social Security income plus any other taxable income plus any tax-exempt interest that you earned through the year. If Social Security is your only source of income for the year, you generally don't pay any tax on your Social Security benefit. But if you have other sources of income, like withdrawals from a pre-tax IRA, pre-tax 401k, or if you have pension income, then you might have to pay taxes on that Social Security income. So the question becomes, how will your Social Security affect your taxes in retirement? And up to 85% of your Social Security could be taxed, which means that at least 15% of it will be tax-free. That doesn't mean there's an 85% tax rate. What it means is that up to 85% of your total Social Security income could be included in your taxable income and taxed similar to wages. The more you earn, the more likely it is that you'll pay tax on your Social Security. Now, I've been doing this for over 20 years, and here's a pattern I see over and over. If you retire with more than $1 or $2 million in pre-tax accounts, there's a good chance you're going to be paying taxes on most of your Social Security income each year, if not 85% every year. The exact percentage that will be included in your income rises as your income rises, and I'll show you how to find that in a minute. And the extra income that's a result of including some of your Social Security income is taxed as ordinary income, which is similar to the earnings you got when you were working. That's generally the least favorable type of income when it comes to the tax brackets. And remember that even the untaxed portion of your Social Security could still affect your finances. For instance, that untaxed portion is added back into your income if you are trying to get ACA credits or trying to get health insurance on the marketplace or exchange and hoping to get those subsidies. Now, how do you estimate how much of your Social Security is going to be taxable? The IRS has a calculator that's probably the most robust tool, but it's a little bit cumbersome. For a lot of people, the Dinky Town calculator is probably adequate for some quick estimates. For example, you would go to dinkytown.com, that's all one word, and then you can enter various things in there. For now, let's assume we're talking about a single taxpayer who has $3,000 per month or $36,000 per year of Social Security income. Again, if that is your only source of income, then the amount that would be taxable is probably going to be nothing. But we can start assuming that you're going to have other types of income. So we'll assume you pull some money out of your pre-tax IRA because you want a little bit more than that for spending. So if we add, for example, $30,000 a year of withdrawals, then what happens is you have $16,400 of your Social Security benefit becomes taxable or is included in your income. And we can figure out what percentage that is if we divide what we just got, 16,400 divided by 36,000, and the answer is about 45% of your benefit there is taxable. You can see that it's, again, not necessarily always exactly 85% or always exactly 50%. But what if we say you withdrew $80,000 from your pre-tax IRA? In that case, then 30,600 of your benefit would then be included in your income. And we can again calculate that. We say 30,600 divided by 36,000, And the result is that 85%. You're at that maximum level. Now, what about your age? There is no age at which your Social Security benefit stops being taxable for federal income tax purposes. Again, it's back to your income. Now, just because some of the income might be included in your taxable income doesn't necessarily mean you're going to pay income taxes. So let's go with a smaller withdrawal example and say you only withdraw $10,000 from your pre-tax IRAs. In that case, you'd have $1,500 that is included in your income. But when we go through the entire calculation and the tax return with your standard deductions, especially if you're over age 65, it might end up being the case that you're going to pay zero tax for the year. Whether or not that's a smart strategy over the long term to pay nothing, maybe there are strategies you want to be using, like drawing down your IRAs or maybe doing Roth conversions. That's a different question, a different topic. But be aware that your standard deduction might cause you, or other deductions might cause you to not have to pay any tax. Now, there's also something known as the Social Security tax torpedo. This is where every dollar of income you add to your income has a surprising effect on how your taxes work. You might think you're withdrawing $100 or $1,000 in the 12% bracket. So $100, 12% tax bracket would only be $12 in taxes, leaving you with $88 left to spend. But in reality, you might be paying more like 22%, or in some cases, more like 42% on each dollar that you withdraw. And that can be a big surprise. That happens because you not only added some income from your withdrawal, but you also brought in more of your Social Security income to the taxable income. There's a tax graph on the screen that shows when this applies for this particular example. The details don't necessarily matter right here, but you can see that at some point you can get beyond that. And in many cases, the reality is people are already beyond this because they're withdrawing so much, or they have pension income. So they're already past that point, and they're just at the point where 85% of their Social Security is already and always going to be included in their income. However, if you are in that zone, then it might be worth paying attention to this and maybe considering pulling your money from different sources, maybe taxable accounts or bank accounts. Maybe you don't have much in gains. You might even want to pull money from Roth accounts. It just depends on the situation, and ultimately it might be a nice problem to have. I don't think you want to just avoid taking money out and spending and enjoying it just because you might end up in the torpedo zone. That's kind of like cutting off your arm to spite your finger, if I got that saying correct. So what can you do to manage your taxes? There might be a couple of different levers you can pull, including when you take income and where you get that income from. If you have big pre-tax accounts, just realize that that might cause issues for you down the road. Again, that might be a nice problem to have, and there might be some opportunities to improve things. For example, you might consider moving money from pre-tax accounts over to Roth accounts using Roth conversions before your Social Security income starts. Or maybe you just spend from those pre-tax accounts in the years before Social Security starts. Maybe you retire early, you draw down some of those pre-tax accounts, then you eventually turn on the Social Security benefit. I've got another video that talks about which accounts you want to spend from depending on your tax situation. For either of those strategies, you might even decide that it makes sense to delay claiming for a while you make all of those moves. But ultimately, it depends on your situation. That's called a bridge strategy. I've also got a video on that. Now, how effective all of that will be depends on the situation, like how much you need to shrink those pre-tax accounts. And it might just be that once your R&Ds start, those required minimum distributions, that you may just end up in the 85% zone, regardless of what you do, unless you take very drastic measures. There's another strategy for those who give to charity. You might be able to give directly from your IRA to a tax-qualified charity. And if you do that as part of a qualified charitable distribution, or QCD, then that portion of your income, your RMD, might not ever end up on your tax return, which can be helpful. And you'll want to look at how you're invested in taxable brokerage accounts and what you have going on in bank accounts. If you have a large amount in cash, you're probably showing a sizable amount of interest income on your tax return each year from that cash. That income is forced income. It's treated as ordinary income, and it just pushes your income higher each year. But if you have different types of investments in those accounts, it could work out for you better, at least tax wise. Now, for now, I'm ignoring what level of risk you do or don't want to take, and we're just focusing on the tax impact as it relates to your Social Security. But just for example, you could have money that's entirely invested in the stock markets in those accounts. Again, not saying that's the right move, but in that case, you might get a bit of dividend income and it is taxed at favorable rates. But then most of the income would only happen if and when you sell things at a gain. So you have some control over when you do that. So I hope you found that helpful. If you did, please leave a quick thumbs up. And if you want help figuring this all out, check out my pricing page, maybe send me an email, and I look forward to talking with you soon.